Welcome to Better System Trader, the show where we talk about all things algorithmic and systematic trading. And today we've got a very special guest. I've been looking forward to this one all week. Tom Basso, welcome to the show.
Hey, good to be here, Andrew.
I'm really excited for today for a number of reasons, but I remember it was probably about a month ago now, maybe a little bit longer, you came on the trading panel with Jason and I, and we had a really good discussion. You shared some really interesting insights into, well, we were talking about trading psychology and drawdown, so I thought it'd be great to have you on the show, and so here you are, and thank you for joining us.
It's my pleasure. It was fun last time. Let's make it fun again.
Yeah, exactly. So I just wanted to start with a little bit of context first. I don't want to dig a lot into your background because I know, a lot of people know who you are already, and you've done loads of podcast shows before, but I think maybe just to give us a little bit of a sense of who you are and why, I guess, well, I really like the motto on your website, enjoy the ride. I think that's great because as humans, or I know I tend to do this, we get stuck in all this busyness of life and we forget to stop and relax and go, appreciate everything that's going on. So I'm interested to know about your ride. Can you just give us a quick little sense of your ride through your trading experience up until now?
Well, I started out like most traders, not knowing a single thing about what I was doing. It took me 4 years in futures trading to even break even. A lot of, less and less losses every year. And fortunately, very small losses, a few thousand. So I could handle that with a chemical engineer's salary. But I eventually got profitable and never looked back and just kept ramping it up, and eventually started managing other people's money and ended up managing 600 million, 28 years in the business, retired in 2003. So now I'm looking at my 21st year in retirement. If I go another 7, I will be in retirement longer than I worked at Trendstat. So that'll be interesting. Have to figure out how to celebrate that one. And really what ended up happening with the enjoy the ride concept was just that we were sitting at a pool in Spain, my wife and I, trying to figure out how I was going to deal with all these emails I get from everybody, usually a new trader saying something like, Tom, I know you've had a lot of experience in trading. What books would you recommend I read before I get started? And so I'd answer, and I literally answered thousands of emails at this point. I am not kidding. It's thousands.
Wow.
And I'm pretty fast as a typist. I took typing in high school and I programmed all my life. So pretty good with the keyboard. So I'd flash out these emails, but I'm saying the same stuff over and over again. Yeah. And I'd rather be out hitting golf balls or working in the yard or doing something else rather than sitting here all day. So I finally, we were kicking it around at the pool. There was a glass of Rosado, I remember, involved, little rosé, Spanish rosé. And we're kicking around ideas. And my wife says, well, why don't you do some kind of a mentoring program? I said, well, that's too much like work. I have to be there like a Monday morning at 9 o'clock and have a group of people on a Zoom call. And while that might be great for the people I'm mentoring, that sounds like work to me. So just as soon keep it asynchronous. So something like where emails are sent to me, I can answer them when I feel like it. And we started kicking it around and we thought, well, how about a website? I could put all my information there. And then if somebody asked me a question that I've already answered on the frequently asked questions or something else, I can just say, go see the website. Boom, done. A lot quicker, and you can get it done quick. So that's kind of where the website came from. I'm not looking to get rich off the website. It pays its own way. I'm happy to report. I don't have to dig into my own pocket to pay for it. But it has saved me a lot of time, and I can put everything in one place, all my interviews and all my book recommendations and, video series that I've done, webinars I've recorded, just it's all in one place for people. So that's kind of the lay of the land of my ride for the last, say, 50 years.
Yeah. So I think, you're right. You've done a lot of podcasts and you've shared a lot of knowledge with the trading community. So I guess thank you for doing that. It's quite rare for someone to have someone who's had quite a long experience in the markets so far? I know you're still going. I was thinking about this the other day. There's probably only a handful of people that have your length of experience in the markets that actually do podcasts, write books, share their knowledge on the website. I think that's incredibly valuable to the trading community. When you look back in your your trading career so far, what do you think has been one of the key factors or the key factor in your longevity? How have you survived so long when probably millions of people have come and gone in trading in the markets?
I would say it's sort of two things. I would say one is after reading Larry Height's chapter in Market Wizards, I really started thinking a lot about, as he calls it, bet size, but I call it the risk exposure of each position and the risk exposure of the portfolio. So that would be the first thing that would come to mind that has allowed me longevity, because as I wrote in the book, Successful Traders Size Their Positions. You can, with very simple math that you learned in junior high school, you can set your exposure to risk based on changing your position size up or down until it's exactly where you would feel comfortable over the long run. You rate it too high, like if you start doing 2% risk in a position and you got 50 positions and all those positions go to their stop loss point, you just wiped yourself out. And you won't even get that far because you get margin calls before that, and your broker will liquidate your positions. So there's some kind of a reasonable maximum that you can even logically take. There's zero, which would get you zero return and zero risk. There's a happy medium in between that each trader must decide for him or herself, where they need to dial it in. It's comfortable. It's not going to cause them to blow up, and they can size their positions appropriately so that all their positions are contributing to the potential profit or loss as a portfolio, rather than I've gotten NVIDIA that everybody's watching today. That hopefully they're watching CNBC or Fox Business and they've got it on mute and they're watching this live. But I get it. There's a lot of people in the stock these days. But if you're sizing your position so that you have one very large position that is appreciated a great deal, it's now 20% of your portfolio, and all the rest totaled equal 10% of your portfolio or something, and you got a bunch of cash sitting around, you don't have a portfolio. You have an NVIDIA and some other stuff. And I think that's what I see a lot of people do. They lock onto a certain size of position. They let their positions run as a good trend follower should, but they don't ever modify that position. And what that leads to is an imbalance in the portfolio. So you have higher risks, higher drawdowns, a lot more test of your of what I would call the second part of longevity. And the second part of longevity is, once you've got your position sizing, risk management correct, the next thing you got to have as a trader is you got to have awareness and discipline. You need the awareness to be aware when you go off of your plan, and you need discipline to put yourself back on the tracks. If you don't have those two things, and you should work on both of them, you got to start with awareness so that you can tell whether you're being greedy and wanting to cut the trade short a little too quickly and you're not letting it run like you should, or if you're pissed off because the last trade you did was a loser and darn it, you're going to go in there and try to make the money back quick, and you double the position size just to teach the market a lesson or something. Those are classic problems over the long run if you have that kind of mentality. So I've been very even keeled for a long, long time in markets and trading. And to me, putting on one more trade is about as easy as breathing at this point. And I think that's been the second part of my longevity, is just sticking to the plan. I have days where I'm fifth day in a row of losing money or something. And, I usually maintain it pretty well, but there's some days where it catches my attention and I think, wow, that's getting a little bit impactful here on my psyche, but I try to balance myself out. When I'm in a drawdown, I think of when I'm making new highs. When I'm making new highs, which I did yesterday afternoon when I made my run, I was at new highs on the equity curve. And I kind of remind myself that, hey, a drawdown is right around the corner. And here I am today in the start of another drawdown. So, I try to balance myself. And I think that's the key to success too. If you're all over the map, you'll never be able to stay with the plan.
Yeah. Yeah, there was so much in there, Tom. So I'm not sure exactly where to start. But I love that you. I guess the answer there is risk management. Sizing your portfolio, your positions correctly, watching how your portfolio is constructed, adjusting positions, that kind of thing. Now I know you released a book. I think it was last year, All Weather Trader, and a lot of that. A big chunk of that book is really about risk management and how do you not just look after your positions, but your portfolio and things like timing the market, extreme diversification, I think are really good topics. Now, in your comment there, you said something about 50 positions as an example. I imagine some people are like, oh man, that's a lot of positions. Why do you need so many? Can you talk a little bit about this term? You said extreme diversification. I was like, well, that's pretty cool. Why is that better than traditional diversification?
Yeah,
Can you explain a bit?
When you're starting out, a new trader might have, I don't know, if they're lucky, $10,000, $20,000 or something on that scale. Fortunately, in today's world, everything from you can do almost fractional shares at some brokers, so you can get down to very small sizes of positions in equities. And then over on the future side, you can get down to the micro contracts, which have been produced so that by mostly CME, so that you can get down to very, very small sizes of things like crude oil and things like, some of the other commodities you could trade. So it allows everybody to diversify across more positions. Now, the reason I say that's important is it's sort of a freebie. If you could magically trade 50 or 100 positions and somehow keep track of it all, either using computers, do some programs, use some of the existing software out there if you can. But what you end up seeing is that then any one thing in your portfolio that goes against you or for you that day is not going to super impact. It's obviously going to impact because everybody's going to have its little 0.1% impact if it goes your way. But the big moves, what you don't want to do is wake up in the morning and you go in and you look at your computer and your whole portfolio is up or down 10%. That kind of grabs your attention, and usually not in a good way. So what I like to try to think of it is you're trying to dial it in so that each position is reasonable. Now, in my case, since I'm managing a reasonably sized portfolio, I've got it across about 50 to 55 positions on a given day, sometimes as much as 60. But I'm trading like 30 different futures markets. I've got a whole bunch of ETFs. I've got some option credit spreads. So there's a lot of stuff going on. I'm trading 10 strategies and right now probably about 50 positions, I'd say. If a person's starting out, if they can only, start with smaller amounts of money, maybe 10 at least. Don't put all your money in one stock or 3 stocks. Try to get to 10, try to get to 20, grow your portfolio, add more cash, spread it out more. If you can do stocks and futures, you've got that much more diversification than if you're just doing stocks, because the stocks are all going to tend to go the same way at the same time. You want things that go different speeds, different times. You want some that are going up and some that are going down, and be able to exploit all of them, and it'll just smooth out your track record.
Yeah. Some people or some traders might say, okay, I trade stocks, mostly long only, but I do have some short only strategies which will kick in when the market drops. Do you think that's enough diversification? What's the minimum, I guess?
If you're trading $10,000 or something, probably. You're not going to be able to all of a sudden go into futures and trade 20 different markets. But your goal should be to get there if you can. So what I did myself is I started out, fortunately, this was just good luck on my part, in the 1975 time frame, and there was a very nice bull market in the US, 75, 76. So my stock portfolio went from a few thousand, and I was able to get it all the way up to about 100 and something. And a lot of that was adding money in from my chemical engineering salary. I was single at the time, rented an apartment, didn't even buy very many furniture for the place. I tried to keep very minimalist expenditures. And I really was able to get my portfolio a lot larger because that was what I was committed to. And then when I had it up to that level and I could get some returns, fortunately, with a nice bull market that we had, that allowed me to then fund the futures trading, which then started me down that path as well. And then the rest of my life, I've been doing both kind of. And the reason I tend to gravitate towards ETFs nowadays is in retirement, like, again, all the people, I hate to pick on NVIDIA here, because the earnings are coming out, but it's amazing how many people have to focus on a ticker symbol because they're enamored with it, or it's a large part of their portfolio. And you see it in the Twitter posts. They get really, really watching every move up and down, every earnings call, every analyst changing their opinion. And I like to think that if I have 50 positions in my portfolio, they're kind of like 50 children. I love them all. I don't want to favor one over the other at all. I just want to let them do their thing and have the discipline to keep them in reins, keep them disciplined as children. But I don't want to get too much emotionally attached to any one of them. And I think that's kind of where I go. So try to get as large a number of diversification as you can. And the key is look at how these things move together. If you're buying 10 different tech stocks and that's your diversification, it's not so much diversification. If you look at the NASDAQ index and you look at your 10 stocks, you'll find that they all move kind of the same way. And so you're going to have good times when they're all moving up, and you're going to have bad times when they're all moving down. And that's not diversification.
Yeah. As you were explaining that, I had a memory in my head about. Now I may butcher this. I'm not exactly sure. I think it was Ray Dalio produced or shared a video about the value of diversification, and I think the implication out of that was that after maybe 7 or 8 strategies, the benefits of diversification start to drop. I think that's what it said. I might have completely butchered it, but do you think
that's called incremental benefit? Yeah, the incremental benefit gets minimal.
Yeah. So do you think then that because if you're looking at 50 positions or all these different markets, do you think there is a reduced benefit at a point? It is like, is there a maximum where it doesn't really help to go over that?
Yeah, a guy who teaches a seminar last time in Vegas with me, Lawrence Bensdorp, he's with the Trading Mastery School, and he's written a book, Automating Your Stock Portfolio, that I really like on multiple systems trading. Lawrence is now trading about 55 strategies simultaneously. And he uses computers to do that. Obviously, it'd be almost impossible to do it by hand. But he claims that he gets a little bit of incremental out of everything. Now, for the amount of effort that you normally would go through to try to add another strategy, I question whether he's getting that much benefit out of one additional strategy. I think if we very carefully picked apart his strategies and ranked them and looked at their effect on the total portfolio, I'm sure even he would agree that the top 10 or 15 would probably be 90-95% of all of the gains and losses and things that he's enjoying or suffering at the time. And the others are just modifying it ever so small amounts. But for him, when he's got everything automated, adding one strategy is not a big strain. He just hits the button and they all run. So if you were doing it by hand, that one strategy's got a lot of cost to it in your time and in your potential for error and in consuming up your cash and all these things. And you have to be pretty careful when you add another strategy. So I think that you're right. Somewhere I've got 10. I'm actually trying to see if I can combine a couple. I'm going to probably do a Substack piece on that in the coming month or so, but I'm contemplating taking my 10 strategies down to maybe 8 by combining a couple things, making my exposures, get my exposures there by doing less strategies rather than more. I'll still have, 8, which a lot of people have 1. So,
Mm.
And I've got some ideas on some things I'd like to do to expand the number of strategies at the same time. So a year from now, I may be telling you I have 10 again. But I try to make my life as easy as I can. I try to consolidate where I can, get the exposures right. And then I just let the market run where it runs. And I try to exploit it when it's there. And I try to stay out of trouble the rest of the time. And life's good.
Yeah, yeah. So I imagine now people who are live listening to our discussion are probably thinking, okay, do I have enough diversification? What markets should I look at to diversify, what I'm trading now? How would you, or what would you recommend to those people to, first, I guess, assess what they're doing, and then how do they pick markets or assets that they should look into to broaden their diversification?
Well, I'm probably more knowledgeable, I would say, of what's happening in the U.S. So you're over in Australia. I've tell you, I spoken to yesterday. I was on an interview with India. So everything's different in each of these countries, and sometimes things as simple as, like in Europe, I heard the SPY, which is this massive couple hundred billion shares or million shares a day trade of SPY indexes, the index ETF, and you can't buy it over in the EU. Crazy stuff. And I'm not sure why. They might have their reasons, but it doesn't make any sense to me. It's a good vehicle. A lot of people trade it. It's highly liquid. It gives you exposure, which, if you want that exposure. So I don't know that there's any logical financial reason for it. Probably something with government, or they've got competing products in the EU that they want to protect, or, all the political stuff that goes on. But if you look at how I get diversification, I look at ETFs. You can buy a small amount of them and get a maximum amount of diversification. So if I want to buy semiconductors, I can go look for a semiconductor ETF, buy it, and I already own, 25 or 30 semiconductor companies. And one of them might be NVIDIA. So I've already got NVIDIA in my portfolio, and I don't even know it because I'm looking at a ticker of a global ETF. If I want exposure to what soybean prices are doing, I can trade a ZS contract, a mini soybeans contract. Now, just thinking through common sense, no math involved. I'm not going to talk correlation coefficients because everybody, their eyes glaze over. But if you just conceptualize the fact that soybeans and a semiconductor ETF should have nothing to do with each other, that's what you're looking for in diversification. So anything you can put in your portfolio that has the potential for profit that you really feel is not really interconnected with the other thing, you've added one unit in the right direction. So start out wherever you are, add another thing that is diversified, try to find something else. Maybe, you got the semiconductors and you got the soybean contract, and now you're going to add an Ethereum futures contract. It's cryptocurrencies. It doesn't care what soybeans is doing either, and it doesn't care what the stock market's doing. So maybe, that's what you add. That's what I'm talking about. It's just common sense, adding layers of things that don't relate to each other. Does oil really care what the Japanese yen is doing? I don't know. Probably not too much. How about, U.S. Treasury bonds versus what's happening in the lumber market? Probably not too much there. Maybe interest rates affecting mortgages, which affects construction, which is affecting lumber prices. you could argue that there might be some tie there, but if you actually put the data in there and truly looked at how it works, there's probably not 100% correlation to those two markets. So you're just adding little diversifications along the way, and eventually you kind of get diversified enough. I mean, at about 20 or 30 items in your portfolio, if they're reasonably diversified, you're doing all right. If you can get to 50, you're managing a very large account. So
yeah. Yeah, like what you said there, we tend to, I think, overcomplicate things sometimes, and sometimes just a little bit of common sense is all you need. So I like how you've kind of simplified that idea, and I think as well, hedging is another aspect of trading that people probably try to overcomplicate. So I want to ask you about that in a moment, but first, just stick on diversification for a little bit longer if we can. So we're talking here about diversification across markets and assets, but what about the approaches that we use? I saw in your book actually a really neat term, which I think you took from someone else, I'm not exactly sure, called filling the potholes. I was like, it's a pretty brilliant way to look at, or can you explain what that means?
yeah, I stole this from Lawrence Bensdorp, actually. He's the one that came up with the term that I heard first, and I just loved it. So I've been using it ever since. If you look at a graph going up the page and you imagine it's a straight line, that would be a wonderful road to travel. The ride would be very smooth indeed, and everybody would probably enjoy it. If you look at a real track record, there's these nasty little potholes along the way where it goes down and then comes back, hopefully rallying to new highs on your equity curve. So my goal as a developer of new strategies is to figure out how can I reduce those potholes, at least make them less difficult to travel through. Maybe I don't eliminate them all the way. That would be a great goal to go after, but I haven't figured out how to make the line a perfect straight line yet. But I'm farther along than when I started the journey, so I've made some progress. But if you ask yourself during the pothole, if you go back in history and say, well, what was going on then? Where did I take losses then? Was it in my long-term strategies? Did my short-term strategies get whipsawed like crazy over and over again? How did I create that drawdown? And really analyze it. You may find it very stimulating in how you could come up with different markets or different strategies, different time period that you might use. And we didn't mention on diversification by time period and diversification by indicators. Those are other forms of diversification that are pretty easy to tackle if you really want to as a trader. But as you start getting all these things happening, I'd liken it to that old cutaway view of a motor in a car, the engine in the car, and all the pistons are going up and down at different times. One's at the high of the cylinder and it's firing off and being blown downward, and the other one's down at the bottom and bouncing off, and they're all attached to the crankshaft. And guess what? Even though they're all doing different things at the different times, the way the engine is created by engineers, they're all attached to the crankshaft. They all make the car go.
Yeah.
And that's the way I look at all my positions and all my indicators and all my time frames. They're just all pistons of that same engine. I'm just trying to make the portfolio move forward. And so you don't necessarily, I've seen situations where you can add a strategy that literally slightly loses money, like a hedging strategy. And that's on my website. People can go look at the hedging page, and I tell people exactly how I hedge. That strategy over a long period of time will lose 1% or 2% on average. There's times though, in a bear market like a 50% down 2008, where you're going to get really slammed in a long stock portfolio, where the hedging will make a ton of money. So if you're long a bunch of portfolios so that you're making money when it goes up and losing money when it goes down, and then you put in place a hedge the opposite way, notice my hands are the opposite direction now, and the hedge is making money as the market goes down while this one's losing, what you're doing is netting out to zero roughly. You may still own some stocks long and maybe some core positions that you don't want to let go of. You don't want to take the tax burden on it. Who knows? There's lots of reasons that you want to have some of those positions there. But in the meanwhile, for a quick buy and sell, you could put a hedge in place and then take it off and net a big profit to offset your losses. And guess what? At the bottom of a big bear market, the greatest time of all to buy, you've just made a whole bunch of cash. So you've got a whole bunch of firepower to go in and add to your existing positions if you wish, add some new positions if you wish, add some more diversification if you wish, start up a new strategy for the next move upward. Lots of flexibility there. Without that hedge in place, you're suffering through a big drawdown. Now, if you're down 50%, you got to go up 100% just to get back to where you were. That's a tough thing to do as a trader.
Yeah, that's a common I guess argument against hedging is people will say, well, why don't you just get out of the position? Like, why do you want to complicate it by managing even more? You just touched on a little bit there. Can you expand a little bit on why you think you should hedge rather than just exit?
Yeah, sure. In some cases, like I said, people have core positions. They may be worked at XYZ Corporation, and they've got 200,000 shares of the stock, and they got it when they retired, and they don't want to dump it on the market all at once. They may even be restricted in dumping it. They may have huge tax consequences if they dump it, and they don't want to take those tax consequences in any one year. They may want to spread it over 5 or 10. So their position has market risk. It also has corporate risk. I know of a lady that was retiring, a friend of mine, and she was in a pharmaceutical company and was responsible for a lot of their Far East sales. And so she worked really hard, made a lot of money, pension plan, options, had a lot of the company stock. Well, as she was going into retirement, it just so happens the stock market went through 2008. And so right out of the gate, she saw her options and some of her positions just get thrashed. Yeah. And she did nothing to hedge it. She didn't feel like she could sell it because it was going to be a massive tax consequence. So guess what? She had to just stick with it, and it's recovered nicely. So in the end, everything is okay, and she was never in trouble of being thrown out on the street or anything. So it was all good, but it teaches you a little lesson in that there's lots of reasons. There's other people don't want to trade the stocks because of wash sale rules in the United States. You got to go, I think it's 45 days or 60 days. You can't be buying and selling inside that period and take losses and actually take them off your taxes. So people want to have a little bit longer holding periods. And in some cases, as long as the stock meets their criteria, they want to hold it. But they still have market risk. There's lots of good stocks. If the stock market goes down 50%, I guarantee you, even a good stock will be down 35, 40. Yeah, they beat the market, but you lost 35%. That's not exactly easy on the psyche. So hedging it just kind of smooths out your brain. All of a sudden you realize, my account value is staying relatively unchanged, and that it makes it a pretty easy ride.
Yeah. What when I was reading your book, actually, I was listening to your book on Audible, and the way you explained your hedging strategy, it was really so simple. It's like, why doesn't everybody do this? It doesn't have to be complicated. Can you share a little bit about how you implement this so people can see, like, it really doesn't need to be a complicated setup to do this?
In my case, what I do is I use 3 trend following indicators: Donchen, Bollinger, and Keltner. I use 21 days to take a hedge off. I use 50 days on my parameter sets to put it on. The reason is I want it to be an upside slanted hedge program. I only want to hedge when things get really bad, and I want to preserve my portfolio in retirement so I don't have to go back to work or something. And then on the upside, I just as soon take the hedge off pretty quickly and let the stocks run. So 21 and 50, and I use those 3 indicators. I outline it on the hedge page. And for me, it's easier to do a S&P 500 futures contract rather than trying to short an ETF like SPY. The reason is the tax structure is better for me. Liquidity is excellent. I've traded commodities and futures for about 45 years now, so that's pretty easy for me to do. I just get I get less consumption of my capital to put the hedge on, because shorting the SPY would require far more in terms of margin utilization than would doing one futures contract. So that seems to me the most capital efficient, easiest to do. I think each person needs to come up with their own way or their own vehicle that makes sense to them. I had one guy that was direct messaging me for quite a long while on hedging and trying to figure out what I was talking about. And he told me that he travels as a salesman around the Pacific Rim. That was his job. So he knows a lot about Pacific Rim oriented companies. And so he put his portfolio together knowing which companies that he thought were doing a great job of business. So he had a very eclectic portfolio that involved different denominations in currencies. And so he's diversified a little bit that way. But he still thought about, if we have a worldwide bear market, which can happen easily, how do I hedge that? And so I suggested to him, well, try to find an index or a hedging vehicle that matches the individual stocks that you own. So he put them all together in a kind of a portfolio, and he went out searching, and he found an ETF that traded in the US that did nothing but Pacific Rim companies. So he shorted that against his portfolio of Pacific Rim stocks. He said, it's a perfect hedge. I love it. And it's smoothed out my performance. And thank you very much. And I haven't heard from him since. That's kind of what we're talking about here. If you've got a portfolio of just tech stocks, maybe the NASDAQ 100. If you've got small cap stocks, maybe the Russell 2000 or the Russell 3000 or whatever you can get that matches up better to your portfolio. If you're just in Europe, look at the IFA, the index over there that covers the European stocks. There's futures contracts on some of those. There's lots of ways to play it, but come up with a vehicle that you can make money to the downside while your rest of your portfolio could be struggling.
Yeah. You said, what was the term now? Just slipped my mind. Diversification with indicators. No, that wasn't it. You're talking about your hedging strategy, and you had, I think you said 3 indicators, right? Why do you have 3?
Donchen, Keltner, and Bollinger. And the reason I like those is if you study the math of each of them, and I recommend everybody do this to every indicator that they ever consider using. Don't just go on your trading platform and say, oh, that looks like an interesting indicator. I'm just going to throw it up on the graph and see what it looks like. I recommend you go into the definition of that indicator. Go over to investopedia.com is wonderful for that. They'll give you the math behind the indicator. They'll tell you how it's typically used. They'll give you some examples sometimes of the indicator in use, and you get a good perspective of what is it that this indicator is trying to do. You have to understand what the indicator is trying to do so that you can trust it when it does its thing, and you can take that signal flawlessly and without emotion, and you know what it's doing the right thing, you know what it's going to do for your portfolio, and you just, you execute. So the reason I like those 3 indicators I just mentioned is they all have a component of measuring the volatility in the market. So I like to think of prices as being in a noise band most of the time. You can, especially the last few days with everybody waiting for NVIDIA earnings, markets have just been going inside days, a little quiet. Well, in that type of situation, if I drew a line on the top and the bottom across the last, say, 20 days, 21 days, I would be saying that everything inside that top and bottom band, and that's a Donchen, for instance, everything inside there is noise. That's not really meaningful information for a guy that's a long-term trader like me. Now, anything outside that band to the top side means you're in an uptrend. Anything on the downside, that would mean you're in a downtrend. So if I ignore all of that noise band and I take all the buy signals and I take all the sell signals, I'm going to pick up 100% of every single major move in both directions over time, over the last 50 years. The reason I like all three is they have different math that they use. Bollinger's uses for volatility the standard deviation of the price movement over the 21 days, let's say. Keltner's used the average true range over the last 21 days. And Donchen could use the price channels over the last 24 days or 21 days. And by doing the same time period across three different types of math, you really are capturing the noise band versus the information. And I just try to use all three, and I use whichever one's hit first is the one that triggers my sell or my put the hedge on and take it off. Easy to do. I can set it up good till cancel orders. Go out to the golf course. If the hedge goes on, it goes on. I find out about it when I get back. It's super easy.
Yeah. Just one more question about hedging before we move on. We've got some questions in the chat here. How do you work out how to size the hedge?
Size the hedge is pretty easy. I take the percentage movements of my portfolio over on one side of the spreadsheet, and I do it in percentage terms. So let's take the last 21 days of all the percents up and down, and I turn them all into absolute numbers. So I take away the minus signs. I just want to know whether it was up or down a lot. And then I take at the same time the hedging vehicle. So in this case, maybe the S&P 500 index, which represents the futures contract that I'm going to use. And then all I do is match up those two, and I say, okay, here's how much money I have, and here's how fast it moves, percentage-wise. Here's how fast the instrument moves percentage-wise. How much of the instrument do I need to balance those two out? And so it's some simple math on a spreadsheet, and that tells me how many contracts I got to put on.
Yeah. Do you ever adjust that during a hedge?
I do. And the obvious good way to adjust it is the market crashes. My portfolio on the long side is getting killed. My hedges are slaying it and making a bunch of money. But some of my long portfolio starts hitting stop losses and starts going more and more to cash. As they go more and more to cash, my long portfolio and my short hedges are getting out of whack. So I need to bring them back into whack, into line. And so I got to peel off some of the hedge position so that it again matches my portfolio. And that's usually at a very nice profit. So good problem to have. But yeah, I do adjust it to try to keep it matched. And eventually, if the portfolio on the long side were to go to zero, my hedges will go to zero. I don't have anything to hedge anymore.
Yeah. All right. Thanks for explaining that, Tom. That was really helpful. Got a question here in the chat from Chris. This is actually a two-parter, so maybe we can do one part at a time. Thanks for the question, Chris. So the question is, you said you're trading two ETFs. How do you remove survivorship bias and or choose the ETFs to put in the backtest?
Okay. On that one, I would ask the question of some place like Norgate. Premium Data might have a database, and I think you can specify that you want the data from all instruments, including those that are delisted, basically, is the term I would use. Delisted means they've gone bankrupt, they went private, they got bought up by another company. There's lots of ways, but the ticker disappears. So ask that of your data provider. That's how you would try to get that correct. You're going to have a lot of ETFs because ETFs didn't really come in till in the 2000s heavily. So you're going to have a lot of mutual funds before that. So you're not going to do really super long-term 80-year studies, but you certainly could get some data over the last, say, 15, 17, 18, 19, 20 years. That's how I would do it. And I would just ask for what the policy is on delisting within the database. And that's the database you want to use.
Yep. And then the
How do you
second part to
deal
that
with,
question, how do you deal with too many signals given the cash in the account?
Okay. What I do there is I do a rough calculation of how much cash I have, and then I have in position sizing, I size each position as a percent of equity. So I first calculate the risk of the trade to the stop loss point, and I make that a certain pre-specified percentage of my equity. So I know, simple example, you're going to buy something at 100, you're going to sell, your stop loss is at 90, so you've got $10 of risk per share. So then the question is, how many shares should you buy? Well, let's say you've got $100,000 in the portfolio. You want each position to have no more than 1%, which would be 1,000. 1% of 100,000 would be 1,000, would be the allowable risk for this position. If I've got now $10, I divide the 1,000 by the 10, and I get 100 shares. So I should buy 100 shares of that position. So that's the math involved. It's all covered in the Successful Traders Size Their Position book. Simple math. It's easy to do. You can put it up in a spreadsheet. Now, I also then look at the volatility the same way. I'd use ATR, or average true range, and I calculate the volatility of the position. And I say that can only be a certain small percentage of my equity, and I limit the positions for that. And let's say that calculation came out that I could do 89 shares. Well, if I got one calculation saying 100 shares and another one saying 89, I'm always going to err to the lower side, 89. Then I do one last calculation. I say I don't ever want a single position to be more than 10% of my portfolio. So I would then do a calculation of, if I've got 100,000, the maximum dollar size in the position can't be anything more than $10,000 for 10 positions. If I'm at 20, it would be $5,000. Whatever that number is, that would cap it. So no matter what my risk and volatility calculation comes up with, I cap it at that amount. So I never run out of cash. I have a fixed set of portfolios. In my case, I use sector funds, and I would only pick one semiconductor and one utility sector fund and one, precious metals fund, and so on and so forth. So right now I have 30 different sector ETFs that I identified that I wanted in the portfolio. So I have basically a fixed portfolio of potential ETF positions, and I never consume up more than the equity that I have.
Yep. Excellent. Thanks, Tom, for that explanation. Now, I know we're right at time. Do you have 1 or 2 minutes more for another question before we wrap up?
Oh, yeah.
Excellent. Thank you very much. This one is from VM Matt, asking about indicators. Have you considered RSI? What about money flow indicators like on-balance volume, accumulated distribution? I don't know what CMF is. What do you think about those?
All right. Well, RSI, you can calculate RSI a couple different ways. The relative strength of something against an index is one way. The RSI that typically used more lately is where the price or the movement is against itself. The RSI is just one more form of sort of trend following. It kind of ranks the various trend following signals into some sort of a ranking mechanism. So it's a very useful function if you're trying to look at a lot of different ETFs or stocks and then try to sort down. You've already made it through the screening and you've got too many stocks to buy. You've got 40 stocks and you only need 10. Well, you'd like to rank them. Ranking them on RSI is going to give you the fastest movers. And it's a useful function because as a trader, if you're trying to produce a profit let's face it, if the price stays here and a year from now it's at the same spot and you owned it that whole time, you didn't make anything, you didn't lose anything. It was sort of just wasting capital in your portfolio. You need to have movement. You need to buy low, sell high, or sell high, buy low. Either way, you got to have movement. RSI gives you a way of getting a little bit of insight into how fast something's moving, and potentially could be useful in sorting out your possible candidates. On the other indicators, I noticed that money flow, on-balance volume, accumulation distribution. I'm not familiar with CMF. I don't even know what that is. But all those other ones have a volume component to them. Now, that's an attempt to take volume and rate it as bullish or bearish in all of those cases. And I've always thought to myself, that's interesting, because I know that every time I do a trade and I execute it, I am contributing to the volume in that position, in that instrument. And I think I made the right decision for me. And the guy that I sold it to, or the guy that I'm buying it from, also thinks he made the right decision. So I have a hard time understanding how I rate that as bullish or bearish. So I've stayed away from all volume indicators. I just, maybe I'm not smart enough. I just don't see, I rate volume as neutral, and I rate price movement as what I care about. Price is what feeds your profits in your portfolio. Volume does nothing for you. The stock could trade like crazy. Was it Taiwan Semiconductor used to trade for around, I think it was around $2 a share, and the volume would be like 1 billion shares or some huge amount, and it never went anywhere. You know, it just sat there, and there'd be a lot of buying and selling. So I think you got to be careful with volume indicators, and if they work for you, great, use them. But for me, I've never been able to simulate anything that I thought was useful. Usually the price part, like on-balance volume or money flow, it's usually the price component multiplied times the volume that day. And if you really start thinking about it, that price component is really driving the indicator. The volume component, not as much. And so you'll find when you dig into the math that, you know, you might as well just go with what drives the indicator anyway, the price. So.
I like how you, well, I'm sensing a theme here, Tom. Common sense is a big factor in a lot of things that you do. Yes. I like the quote you start off with. It was something like, you really got to understand what the indicator's doing or how it works so that you can trust it to do its thing, right? And
correct.
And I guess that's also a part of you know, what you're doing.
Because I'll tell you what happens if you don't. If I gave you a black box and I said, I got this Basso indicator that I'm going to offer for free on the website, and you just download it and use it. But it's completely encrypted. You can't figure out how I do it. And you input data, outcomes, and order. As soon as it goes into a drawdown, and sooner or later it will, you'll abandon it. You'll say, you know, Tom's lost his screws. He's this is an old school. He's an old guy. He doesn't know. You know, he's trading like he did back in the 70s, and this doesn't work anymore. And then you go on to the next best thing. By understanding it and realizing that, oh, okay, this math that I thought was smart should be losing money right now, and it is, but it's reversed my position. I had a little drawdown. Now I'm short instead of long. We're doing okay. If the market continues down, I'll be making a lot of money. You start giving yourself that confidence to stick around and keep doing what you're doing. I think you have to look at an indicator from the standpoint is it doing what you would expect it to do in the time period that you're looking at it? And if the answer is yes, then it is not broken. Don't try to fix it.
Yep. Well said. And a good way to end the show for today, because we're at time. So thanks a lot for your time today, Tom. Now, how can people either get in touch with you or learn more from you? How can they follow you?
Well, the enjoy the ride.world is obviously the website that with all the information. So that'd be the easiest place to get a lot of information on Tom Basso. Tom@trendstat.com is the email address. If you have specific questions, let me try to plead with people that if you're going to send me an email, please go to the website first and see if you could answer the question there. Saves me some time. And if you are going to send me an email or a direct message or anything, be specific. Don't give me one of these, I'm just starting out in trading. How do I get started? That's what I could write a book on that, and I still wouldn't cover it all probably. So you got to try to narrow it down to a specific issue that you're having, and maybe some supporting documentation and charts. And Twitter is probably the most frequent way people follow me. I think I've got 54,000 followers on Twitter, and that's just @Basso_Tom. And beware, on social media, there are, I don't know, over time, about 25 or 30 other Tom Bassos out there trying to con people. So be very careful. It's just @Basso_Tom. There's only one. I only have one account, and I will never try to sell you anything in direct messaging or try to get you to go over to Telegram to have a private conversation or anything like that. So I've had people get scammed, and it really makes me mad, but there's not a lot I can do about it. It's up to Twitter and Facebook and all these other social media sites to get that under control. And so far, they're not doing that. So beware.
Yep. Yeah, that's right. So thanks again for your time today. And thanks everyone for attending the show or watching the replay. If you're watching this later, please remember to hit like and subscribe so you're notified whenever we release new content. Now, Tom, any closing thoughts before we finish this one up?
Just that there's a whole lot of markets that are in tight bands looking like they could be dangerous. So right now the direction's up, and I'm fully bullish and fully long. I'm not bullish would imply that I think it's going to continue. I just think the market could go farther up, or it could just fall flat on its face. So I would just be very cautious and nimble if I were suggesting to traders, be on your game. This could get a little dicey.
Yeah. Excellent. Thanks, Tom. I just wanted to share a really nice comment in the chat here just to finish up. This one's from Zoran. Zoran posted an earlier comment saying it's 5:30 in the morning, so thanks for the dedication. But it says, goats like Tom and Jerry, no pun intended, are always so generous. Tom Basso and Jerry Parker always give nuggets. We'll never try to sell you something. Thank you. So thanks for everything that you're doing in the trading community, Tom, sharing a lot of your knowledge. And it's really, really valuable. And we're getting other thanks in the chat here as well. So thanks again. And wish you all the best.
Thanks.
Cheers, Tom. Bye.
Bye.